All right, welcome everyone. Today, we're putting a company you probably know, Trident Limited, under the microscope for a full-on financial health checkup. Let's dive right in. You know, there's a pretty good chance you've got a Trident product in your home right now. They are an absolute giant in textiles globally. But here's the real question we're digging into today. Just because they're a household name, does that mean they belong in your portfolio? So we're going to flip things around a bit today and start with the final verdict right up front. Our analysis points to a hold rating for Trident. We're looking at a base case target of around 28 rupees. Now that's roughly a 12% upside from where it's trading today. And that is the million-dollar question, isn't it? It's what this whole analysis is all about. A hold rating means there's a real tug of war going on here. You've got some really compelling strengths, but also some pretty big weaknesses. So let's unpack that story together. Okay, so to really get our heads around this hold rating, let's start with the good news. This is the bull case, the stuff that makes Trident such a powerhouse in its industry. First off, you just can't ignore their massive scale. Trident is literally the world's largest manufacturer of terry towels. Now, that's not just some fancy title. It gives them this incredible advantage in production capacity. And that creates a huge moat, making it super tough for anyone else to compete on volume or price. And what's really impressive is what they've been doing with their cash flow. I mean, look at this. In just a single recent fiscal year, they cut their net debt by a massive 635 crores. That kind of aggressive deleveraging makes their balance sheet incredibly strong and way more resilient. So when you put it all together, the argument for being optimistic really boils down to three big things. You've got that massive global scale we just talked about, a super strong balance sheet because they pay down so much debt, and then you've got these potential long-term boosts coming from new trade agreements like the India-UK FTA. But here's the pivot. For all that good stuff, for all its structural strengths, the company is facing a really, really serious problem with its profitability. This is the other side of the story, and it's what's holding the stock back. And wow, this chart right here, it tells the whole story. Just look at this. Their operating margins have basically fallen off a cliff. We're talking from a healthy 22% just a few years back, all the way down to a measly 9% in the most recent quarter. That's a total collapse, and it makes you seriously question their pricing power and cost controls. Now, you'd think with profits tanking like that, the stock would be on sale, right? Well, not exactly. It's trading at a price-to-earnings ratio over 31. That's way above its 10-year average of about 22. It feels like the market is pricing in a massive comeback that just hasn't happened yet. You're basically being asked to pay a premium today for a company that's earning less. That's a tough pill to swallow. See, the case against the stock is just as strong as the case for it. You've got those collapsing margins, the fact that it's not even earning enough to cover its cost of capital, and we'll get to that, and a valuation that just feels way too high given the earnings decline. And this all leads to this fascinating conflict, a real tale of two financials. The best way to think about it is like a health checkup, where the doctor tells you your bones are incredibly strong, but your blood work is, well, it's a total mess. So let's start with those strong bones, the balance sheet. We use something called the Piotroski F-Score, and Trident gets a nearly perfect 8 out of 9. This is a fantastic tool that looks at things like debt, cash flow, and efficiency. And an 8 out of 9? That's basically an A+. It's telling us the underlying structure of the company is rock solid. But then, right, we look at the blood work, the income statement, and the whole picture changes. A DuPont analysis, which breaks down profitability, shows us the problem. The company's return on equity is falling, and the culprit isn't their debt levels. It's that their core profitability, the net margin, is just plain weak. The vitals are not looking good at all. And this, right here, is probably the most important question of all. Is the company actually creating value for its shareholders? Look, the company is earning about a 9.5% return on all the money it has invested in the business. But the cost to get that money, from loans and investors, is about 15%. So think about that. If it costs you 15% to use the money, but you only make 9.5% with it, you're actually losing money on every rupee you invest. You're destroying value, not creating it. Okay, so let's pull all this together and do the final math. What does the risk versus reward look like for someone thinking about investing at the current price? Let's look at 3 possibilities. In our base case, kind of the most likely scenario, you're looking at a potential upside of around 12%. But, and this is a big but, if things go south, the bear case, you could be looking at a painful 28% downside. Sure, the bull case looks great with a 52% upside, but you have to weigh that against the very real risk that things could go wrong.
And this single number is the punchline, the risk-reward ratio. So here's what that means in plain English. Based on our scenarios, for every 1 rupee of potential gain you might make, you are risking more than 2 rupees of potential loss. That is not a risk-reward setup you want to see. The odds just don't seem to be in your favor right now.
So if you're holding this stock or just keeping an eye on it, what should you be looking for? Well, there are a few key things. Number one, you absolutely need to see those margins start climbing back up towards that 15% mark. You're also watching for real growth in their exports and want to see clear progress on their expansion plans. These are the green flags that could tell you the story is finally turning around for the better. Now, before we wrap up, just a quick but very important disclaimer. The analysis I've shared here is for educational and informational purposes only. It's really important to note that I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market has significant risks, right? And all the data and charts you saw are based on public information and my own research notes. So please don't treat this as a buy or sell recommendation. You should always do your own homework or, even better, consult with a CBI-registered professional before making any financial decisions. If you found this deep dive helpful and you want to stay updated with more stress-free investing analysis just like this one, please do hit that subscribe button and press the bell icon. That way you'll never miss an update. And now I really want to hear from you. Which Indian-listed company should I put under the microscope next? Drop the stock name in the comments below, and who knows, it might just be the subject of our next deep dive. Thank you so much for watching. Trident really does present a classic investing dilemma, a fundamentally strong company with some seriously weak performance right now. So the question you're left with is, will the strong bones outlast the bad blood? As always, keep your investing stress-free.